معرفة.
Bismillah ar-Rahman ar-Rahim. Now let us understand how the personal finance needs of retail customers are being addressed by Islamic banks. Now let us discuss the first structure. This structure is basically called a tawarrukh structure or a commodity murabaha structure. And let us follow the steps how this structure is applied. Step 1, this is a customer, this is an Islamic bank. The customer needs cash. The customer approaches an Islamic bank. The Islamic bank discusses the amount of cash which the customer requires. Then the customer provides a unilateral promise to purchase to the Islamic bank, mentioning that if the Islamic bank purchases certain commodities, then the customer would purchase those commodities from the Islamic bank. This is basically for the comfort of Islamic bank. Then the Islamic bank, so in this case, for example, the requirement of the customer is $100. So the Islamic bank will purchase Sharia compliant commodities from a supplier in the market for $100. And these Sharia compliant commodities, so the Islamic bank approaches a supplier and purchases these Sharia compliant commodities. These Sharia compliant commodities, and the Islamic bank approaches a supplier, and these Sharia compliant commodities based on different geographies, could be anything. Generally they are metals which are metals which does not include gold and silver, or in some geographies even palm oil is being used. In some geographies some other Sharia compliant commodities are being used. So therefore this could be any Sharia compliant commodity. So what happens is that the seller sells these commodities to the Islamic bank. When we say sell, of course all the sale requirements needs to be fulfilled, meaning to say the assets have to be identified, the ownership of the assets needs to be transferred to the Islamic bank, so on and so forth. So the $100 worth of commodities are purchased by the Islamic bank. Then the Islamic bank enters into a murabaha agreement with the customer. In this murabaha agreement, the Islamic bank would mention that the Islamic bank has purchased commodities worth $100, and the Islamic bank is adding a profit of $5, and the customer is supposed to pay $105 within 1 month, for example. And hence now the customer is the owner of commodities worth $100. Now this customer, because the customer is in need of liquid cash and not the goods, so the customer sells these goods to a purchaser again in the market for $100 and receives the $100. So the cash requirement of the customer is fulfilled, and then the customer is supposed to make the payment of $105 to the Islamic bank over a period of 1 month. Now this is generally the process. Some important point which needs to be kept in mind is that the supplier who sells the goods to the Islamic bank and the purchaser who purchases these goods from the customer need to be two different legal entities. They should not be same entities. Number 2 important thing which needs to be kept in mind is that the ownership of these commodities or assets needs to be properly transferred in the first step from the seller to the Islamic bank, and then from the Islamic bank to the customer. Some financial institutions are also using the structure of salam to provide the personal finance needs of their customers. Now basically in this transaction, the customer, for example, again requires $100. The customer approaches an Islamic bank and the customer enters into a salam contract. As we have discussed earlier, the salam contract is with respect to the customer providing certain commodities which are identified to the Islamic bank over an agreed period of time, and the payment for that should be upfront. So the $100 are paid immediately to the customer, and the customer, according to the salam contract, promises to supply the specific commodities maybe after 1 month So the customer goes and procures those commodities from the market, okay, and the customer provides the delivery, a periodic delivery to the bank, okay, with respect to the goods or the commodities. Because the Islamic bank is not in the need of these goods, the Islamic bank in turn would again, once it receives the goods from the customer, would sell it to the, it would sell in the market and obtain the liquidity. So basically here in this structure, the contract of salam is used to provide the cash requirements of the customer. Now let us discuss about service ijara. Basically, this kind of contract or arrangement is used to provide financing for services like education, medical, and travel. So let us take the example of education. And the student wants his education to be financed. So now if this student, for example, wishes to enroll in an engineering program, and the course is for 4 years, and the cost of that course is, for example, is $100, just for an ease of understanding I'm saying. So the customer approaches the student approaches an Islamic bank, and the Islamic bank in turn approaches the university. The Islamic bank hires these services from the university for a period of 4 years in relation to the engineering course. So the whole cost of that course, if it is $100, the Islamic bank will pay $100 to the university, and the Islamic bank hires or purchases those services which are provided by the university over a period of 4 years in relation to the engineering program. Now once the Islamic bank receives those services or becomes owner of those services, then the Islamic bank will in turn again sublease those services to the student through a service ijara agreement. So the idea is that the service requirements like as we have discussed, education, medical and travel, this also could be financed by an Islamic bank. So the Islamic bank hires those services, purchases those services, and then the Islamic bank leases those services to its customer. So this is a way in which the Islamic banks are financing services of different natures which are Sharia compliant.